All right, good afternoon, everybody, and welcome to our LA Multifamily Meetup. We're so glad to have you guys here. As you know, we're really excited to educate agents and investors and anyone looking to invest who's out there. And I'm Anthony Will, and I'm the broker and owner of the Collective Realty. And we have a couple great guests here for you today. As you know, lamultifamilymeetup.com is our website. So if you're looking to follow us and you haven't followed us, please do so there. This webinar will also be posted on our Facebook page, and then tomorrow it'll be on our YouTube page. So you can just search the Collective Realty on Facebook or YouTube to see these videos and any other ones that we've done in the past as well. So we'll continue to have a library of great information out there for you. So LA Multifamily Meetup is the website to sign up for our meetup group to make sure you don't miss anything. But other than that, I hope everybody's staying safe out there. Market is really starting to pick up on the residential side. So listings that personally I've had and some agents have had in the office have gone into escrow that were maybe on the market for a few months. And there's plenty of multiple offers that are happening right now as well. So on that side, things are very active. And today we're going to talk a little bit more on what's happening on multifamily side and commercial. A great attorney. And now I'd like to introduce you to Will Tiao. He's the director of the Collective Commercial. And take it away from here, Will.
Thanks, Anthony. Hi, everybody. As Anthony said, my name is Will Tiao. I am the director of the commercial real estate division at the Collective Realty. And I also own Tiao Properties. It's a property management team. We manage a little under 200 units, the vast majority in the city of Los Angeles and its surroundings. So we're really excited about our guest today, Jeff Love of Gibbs Giden, to talk about commercial purchase transactions. But before we do that, we always like to give a little bit of an update as to what's going on in the multifamily market, both like the market itself, as well as any legislation that's coming up. To say these are interesting times is a understatement, as I'm sure many of you know, who are already multifamily investors. There's so much going on in the marketplace. I found a video from CoStar, and I'm going to share that video with you guys now. It's just like a little 5-minute introduction on kind of what, like an overview of what's going on in the market right now. So I'm going to try to see if I can pull this up for everybody. Hold on. Apologize, I'm not the most. Can everybody see? Can you guys see this video? Okay, great. So it's like a little 5-minute overview of what's going on with vacancies and everything in the LA market right now. So here you go.
Hi, and welcome to another update on the state of the Los Angeles apartment market. I'm Steve Basham, managing analyst covering LA for the CoStar Group. The coronavirus outbreak and resulting economic upheaval continued to disrupt what is usually one of the most stable apartment markets in the country. Rents are falling in LA for the first time since the Great Recession more than a decade ago, and vacancies are at their highest levels since CoStar began tracking apartment data around the turn of the century. It's starting to seem like a distant memory, but the LA economy was in good shape prior to the coronavirus outbreak. A decade of steady job gains had unemployment near record lows, and that healthy jobs picture provided a major boost to apartment demand. But all good things must come to an end, and the end of economic expansion in LA comes in historically unprecedented fashion. Oxford Economics baseline forecast predicts total job losses could exceed 700,000 in the second quarter of 2020 alone. And incredibly, that may be an optimistic take. An April report from the LA Economic Development Council predicted job losses could rise as high as 1.2 million, with countywide unemployment pushing north of 30%. So what does that mean for apartment demand? Well, it's not good. Newly unemployed renters will look to save costs by moving back home with family or adding more roommates. As a result, net absorption has turned sharply negative, and the countywide apartment vacancy rate is north of 5% for the first time this century. The forecast doesn't envision a quick recovery either. With thousands of new units delivering in coming quarters as demand evaporates, vacancies are predicted to rise near 7% before the market begins to regain its footing. So what impact is this having on apartment rents? Well, between the apartments.com family of listing sites and the efforts of CoStar researchers, we confirm around 60,000 individual rental rates every day in Los Angeles. And this gives us a nuanced, real-time view of how asking rents are moving in the market. And the impacts of the pandemic are clear. Average rents in LA County peaked at $2.50 a square foot in February, an all-time high. Since then, they've fallen by about 4 cents a square foot. That would equate to annualized losses around 6%. And the brunt of these losses are being felt at the top of the market. In high-end 4- and 5-star communities, rents are falling twice as quickly as they are in mid-tier 3-star properties. There are some reasons to hope that the worst impacts of the pandemic are behind us. Rents are still dropping, but at a slower pace than they did in April. And an encouraging regional trend is emerging. In some nearby markets, the decline in apartment rents appears to have ended or actually reversed. Rent losses still haven't bottomed out in pricey LA and Orange counties, where average rents in 4- and 5-star properties are north of $2,100 a month. But in slightly more affordable San Diego, high-end rents appear to have stabilized. And in the Inland Empire, where apartments are about 25% cheaper than on the coast, asking rents actually ticked upwards in May. Now, let's take a look at how the pandemic is impacting the capital markets. As expected, liquidity has really dropped off as investors wait for the economic waters to settle. In the second quarter of 2019, almost $2.5 billion in apartment trades closed in LA. In April and May of this year, only about $500 million in deals took place. And barring a flurry of activity in June, this looks set to be the slowest quarter for LA apartment sales since at least 2012. So far, there's not much evidence of a fall in apartment prices. The handful of trades that did take place in April and May closed at roughly the same average prices in the first quarter. The forecast paints a grim picture, however. If, as predicted, rent levels continue to decline in 2020, average apartment pricing will fall as well. Forecasts envision losses of 10 to 20% before the market bottoms out. There's still a lot of uncertainty in the air. The stimulus payments and unemployment insurance provided by the CARES Act have helped keep rental income flowing, but those benefits are set to expire in June. And meanwhile, the city of LA is reportedly close to a deal that will provide $100 million in rental subsidies for low-income households in the form of direct payments to landlords. And of course, the shape and timing of a recovery will largely be dictated by our public health response. Here at CoStar, we'll be keeping close watch on the impacts of the pandemic and keeping you informed on the latest market trends. I'll be back with another update around mid-year. Until that time, good luck and stay safe.
So you can see that the overall market, what the trends are. Now, I think a lot of those numbers are skewed by the higher end of that market, the kind of A-class category that I was talking about, like the 4- and 5-star stuff that you see a lot of vacancies, particularly in downtown and mid-city and Century City areas. But in the stuff that we tend to focus on, which is more, I would say, B and C class, we're not seeing that much of a drop. Yes, there's a slight drop maybe in some of the rents, but generally speaking, we're starting to get a lot of traffic. Our current collection rate for our properties is above 90%. We're in like the 92nd percentile. And from what we're hearing, that is pretty much across the board, that most people have, most multifamily owners have collected the majority of their rents, vast majority, obviously over 90%. Now, as the speaker was just talking about, That could change here depending on what happens, obviously, with the economy. A lot of the stimulus payments are going to stop, the extra unemployment and whatnot that certain people were using to pay their rents. But at the same time, the economy is starting to come back. Things are starting to open up. So people are starting to go back to work. So it's a little bit of a mixed bag. I can tell you from the sales side, as Anthony pointed out earlier, we are not seeing a slowdown in sales. We have several listings on the market right now. I've had on multiple listings, we've had multiple offers. We are now in escrow above asking on all of our listings. And I think a lot of that has to do with there still is a very low supply. Now, that could change as the speaker was talking about, as the CoStar speaker was talking about, in the sense that we could see a change if the market continues where people are unable to pay their rents and this eviction moratorium ends, which at this point for the city of LA is scheduled to end at the end of the month in a week. Now, we say that, and we also know that that could change like in 5 minutes. Like, there's always, all this legislation that seems to be happening, and we'll get into that in a second. But as of right now, the eviction moratorium ends on June 30th. And if it does, then, and depending on where rent collections go, we could start seeing some more inventory. That I will say that, that 5 to 10% or so of people who are not paying their rents is not evenly distributed. So for example, I have a duplex that we manage in Highland Park. Neither of the tenants are paying rent. So that means obviously for that owner who also happened to lose his job during the pandemic, that they're being forced to sell. Now, that said, like, they immediately got an offer almost as soon as they put it on the market. So because once again, there's not a lot of inventory. Whether that will go through or not, we'll see, given once the buyer comes in and realizes that tenants are not paying rent. So these are all questions that are going to come up as it goes through. But as of right now, there's still such low inventory. Definitely prices are staying stable. If not, they're slightly higher even than where they were pre-pandemic. Now, once again, this could all change based on a number of factors. And the biggest factor, X factor, is legislation, right? As of right now, as many of you know, there is a eviction moratorium on basically anybody who cannot pay their rent during this COVID crisis, as long as it's technically COVID related. The courts are not hearing any cases regarding any unlawful detainers. So, and technically, at least in the city of LA, if you're a commercial tenant, you have up to 3 months after the end of the eviction moratorium period to be able to pay back any back rent. And for residential tenants, you have up to 12 months. Once again, these things are all up in the air. There is pending legislation on the state level to make it a statewide, to extend the payback period for anybody who couldn't pay their rent during the pandemic for up to 15 months. That is not, it's pending, it's not through, but that is something that people are considering. Another thing that the city of LA is considering is a vacancy tax. And the argument behind the vacancy tax is that, there are vacant units in the city of Los Angeles, like there are every city. And the hope, given the homeless situation that we have, there's an argument from certain people in the city council who have argued that we should incentivize landlords to rent out their vacant units. It could be vacant land, whatever it is. And if not, they should pay a tax. Now, there's obviously lots of different ideas about how that would go about. They've sent it to a study group right now to come back to the city council with some recommendations on how that would be implemented. Excuse me. And how that would be potentially put on the ballot in November. There's a lot of us who feel that this is a very not, you know, not necessarily the best way to you know, use our taxpayer dollars, because it would cost, I think they said, about $12 million to put that on the ballot. Also, the vacancy rates in LA are about 6 to 7%, which is not, you know, unheard of. And they're talking about doing a lot of exceptions, exceptions to single family houses, exceptions to commercial retail properties, exceptions for developers who may be renovating a unit. So that could take out a lot of those vacant units. But that said, it's something to watch and to consider. And a lot of people are calling their council members, and we would encourage that as well. I mean, you know, there is also, as the CoStar speaker mentioned, there is talk about $100 million fund that would basically, tenants of a certain class, like meaning like if they make below a certain amount, I had read 60,000 somewhere, I had read 75,000 somewhere else. If they make below that amount, they can apply, and if they are approved, they're like, I think it's up to $1,000 payment would go directly to the landlord. So there are, you know, things that are being discussed right now. Today in the LA County Board of Supervisors, they approved a $30 million rent fund to help renters in the county of Los Angeles. I haven't read all the things. Like I said, these things are just happening very, very quickly. So it's very important that you stay in touch about what's going on. We do our best to stay abreast of everything that's going on here. And that's pretty much it on my end. We do want to, we always try to talk about some of the deals that we have coming up. I'm just going to share a couple of deals. I have one on the market and one off market. This is a on market deal. It's a 5-unit. So it's a 4-plex in the front and a single family in the back. The 4-plex is, there are 2 3-bedroom units on top, 3-bedroom, 1.5 baths. They're both rented at market at $27.75. The bottom 2 units are both 2-bedroom, 1 baths. They're on the market, I think, for $25.50. And then the back unit is a 3-bedroom, 2-bath house with 5 garage units on the bottom, with parking for 10 spaces. And we have it on the market for $2,495,000. And once it's rented at market, the cap rate will be about a 5.4 and a GRM of 14.12. This is in the neighborhood of Westlake, just south of Echo Park and Silver Lake. I have another property that is, let's see. Have another property in Silver Lake. This one, that's Jeff's bio, which we'll get to in a second. This is also a 5-unit, but it has a 3-car garage that the owner has gotten permits to turn into an ADU. So it could potentially have 6 units. And they're all 2-bedroom, 1 bath, fully loaded, washer, dryer, dishwasher, everything. That price is not quite correct. The price the owner is willing to do it for is $2,850,000. That would put it at a current cap rate of 4.75. And then once the ADU, if that were to be converted, then you would be able to get a 5.5 cap rate on that property. And both are beautifully done, turnkey. So for those of you who have potential properties, I do have a client who is looking for a 1031 exchange in like the 3.5 to 5 million range. So if you have anything off market that you'd like to share, please share it in the chat. And you know, if you have any deals or any wants and needs, please put them in the chat, and we'll see. You know, there's always business has been done. We've definitely, in the past when we met live, we've had people transact and do deals and do lots of off-market deals. So it's an opportunity for those of you who have you know, properties out there that want to get them seen, please let us know. So now I will introduce our guest speaker. Jeff Love is an attorney and partner with the law firm Gibbs Giden. His practice encompasses all facets of real estate transactions, including drafting and negotiating purchase, sale, syndication, and financing transactions in connection with commercial, industrial, and residential assets. He also regularly drafts and negotiates office, retail, and industrial leases for regional landlords and tenants throughout the West Coast. He has extensive experience drafting, negotiating, and reviewing real estate loan docs, including originations, modifications, note purchase agreements, and other finance-related transactions. From structuring through loan closing, he is a licensed real estate broker in the state of California. And with that, I'd like to turn it over to Jeff.
Thank you, Will. I'm glad to be here. Let me try to share my screen and get a nice PowerPoint. Okay. So I think it's a timely topic about purchase and sale agreements, given what Will was just talking about with the market. Hopefully more inventory comes up. What I'd like to do is kind of talk about what you should look for in your commercial real estate purchase agreement. What are some of the common mistakes that new investors and even seasoned investors run across, things that have come across my desk, to educate everyone to hopefully get rid of these mistakes and make sure that you're negotiating your purchase to sale agreement to get you the best deal possible to limit your risk. So why do you need a purchase and sale agreement? Well, the biggest reason is the state of California requires anything dealing with land, a purchase or a lease greater than 1 year to be in writing, to be enforceable. But the bigger reason is to make sure that each party understands their obligations and liabilities. Give you an example. Will promised me a wonderful steak dinner for coming and speaking. He probably doesn't remember this. But if we had a written agreement, I could point to it and say, no, Will, you promised me this wonderful steak dinner, and there'd be no dispute. Same principle applies to real estate in your purchase agreement. If you have it in writing, you understand what the seller's obligations are and what the buyer's obligations are. It also helps run through the mechanics of a transaction. So what are your closing covenants? What is my due diligence period? What's the obligation of the escrow officer? Making sure that everyone understands what you have to do throughout the course of a transaction to get you from the LOI stage, signing the purchase agreement, doing your due diligence, making sure you have your financing in order, all the way through closing covenants and eventually closing the transaction. So on this slide, you can read it, but I'll read it as well because I think it's a good kind of story. Is here's a real estate attorney with 40 years of experience, and he refuses to negotiate what the other side calls a deal breaker. We've all seen them in real estate. Some party doesn't want to negotiate price or terms, and the other party comes to him and says, why won't you negotiate this point? We said it's a deal breaker. Do you want to lose the deal for your client? And he says, because my client had the bigger stick. What he means by that is his client had more leverage. So who wants the deal more? Does the seller need to sell? As Will mentioned, in the kind of current economic environment we are now, if your tenants aren't paying rent, if you've lost your job, you may really need to sell. So the buyer that comes along, they may have more leverage in the transaction and vice versa. So just because someone says that something is not negotiable doesn't mean it's the case. There are different types of purchase agreements out there. You might see in the California Association of Realtors Forum. There's one by AIR Commercial Real Estate, and you've got many different kind of customized forms that you may see attorneys draft. It doesn't matter if it's a form agreement or your broker says it's not negotiable. Every point is, it's a matter of leverage. You just need to understand what's important to you as the buyer or seller, and what provisions do you need to negotiate to protect yourself and get the deal done to fit your needs. So that's the purchase agreement in a nutshell. But what are all the other agreements that go along with it? We have exhibits. You've heard deeds, bill of sale. So I want to talk briefly about what these other agreements are, so you have a better understanding of what they are if you get them and the importance of them. One is simple. It's your grant deed. This is the deed that actually transfers ownership of the property, and it sometimes can be negotiated depending on the size of the transaction. If we're talking about a small multifamily deal, it may be prepared by the escrow officer or title company, and there may not be much negotiation. But if it's a bigger deal, and maybe we're talking about a 50-unit apartment complex, an attorney may put certain language in there, restrictions that you want to make sure that it's not restricting your ownership or affecting title at all. Another document is your bill of sale. And this is important. If you are using, let's say a CAR form, there may not be a requirement for you to actually get a bill of sale. But if there's important personal property that's included as part of your purchase, if there's a shed outside, or that there are microwaves, any type of personal property that you want to make sure is conveyed, it's important not only to put it in the purchase agreement, but the bill of sale is when this document will be transferred. General assignment is kind of what it sounds like. If there are contracts, it's a bigger building and there's a contract with a vendor or a landscape company, security company, this is the document that will assign that contract from the seller to the buyer. And you want to make sure that you're understanding what's being assigned and what's not, so you're not taking on more liabilities than the deal really obligated you to. Lease assignment, again, kind of is what it sounds like, but important document to make sure that all the leases are properly assigned. And then if there's any indemnities between the buyer and the seller, this document will outline the scope of those. Last two documents deal with taxes. It's our FERPTA certificate in California, Form 593C. Important to get if you're a buyer, because both federal government and California require tax withholding if you don't qualify for an exemption. These two documents usually will be prepared by escrow, could be the seller's attorney, buyer's attorney, making sure that you as the buyer are not releasing more money than you're required to do and run afoul of either the state of California or the federal government. So now I kind of want to jump into I love top 10 lists, so I made a top 10 issues of what to consider in your purchase and sale agreement. Obviously can't cover everything and every point in a purchase agreement, but these are the issues that if I was buying a property and I was presented with a purchase agreement from a seller, or my broker prepared one, that I'd want to take a quick look at to make sure that I understood, so I understand my risk and what the business terms in the transaction are, and be able to go forward with the deal. So first, property description. It doesn't sound too important, but it can be. And you'll see at the bottom of this slide, I say get title insurance. Title insurance can absolutely help you with the property description, and that's what it's there for. It's to make sure that the land improvements being conveyed are what the buyer and seller negotiated for. But without title insurance, many times they may be friendly parties. There may not be title insurance. I've had deals where, kind of a funny story is, it was a meets and bound description, which means you may have seen them, and it says that the south 1/4 of the bigger 1/4 parcel is being conveyed. And you see 1/4 twice. It sounds like a typo. So my seller in that transaction decided to go and delete the first quarter because he thought it was a typo. And he ended up conveying 4 times the amount of property that he thought he was conveying. Ran into big issues, all because the property description was correct. He made it not correct. So long story short, you want to make sure what you're conveying matches what the documents say. And not just for the land, for personal property too. If you're buying a large apartment building and there's personal property to be conveyed, you want to make sure that that's listed in the purchase agreement and be clear about what's being conveyed versus what's not. If there's artwork that the seller is looking to retain, you want to make sure that that's being excluded, so there's not a dispute later on between buyer and seller because this expensive piece of artwork was thought by the buyer to be part of the purchase price and the seller had a difference of opinion. So really outline what the land is, what the personal property is, and any other rights. If it's a larger apartment complex, or if it was an office building and there's intellectual property rights, or there's a trade name that goes with the building, that may have real value to it, and you want to make sure that that's being conveyed as well, so that you can continue to operate under that name. But if it's not listed in the purchase agreement, it may not necessarily be an item of property that's being conveyed. So listing these other items like contract rights, intellectual properties, which would go in your purchase agreement, and that would go in that general assignment that transfers these rights from the seller to the buyer. Due diligence, big topic, probably one of the most important items the buyer is going to go through in conducting the transaction. Due diligence period is really that, for your new investors, is that time period where you get a free look at the property, where you can do your physical inspection, you can look at title, look at your tenant leases, any environmental concerns, and make sure that everything matches your assumptions and your underwriting to make sure you can go forward with the deal. And you can have a short due diligence period, long due diligence period. It really depends on the buyer and their familiarity with the company, with the property. But some of the items that you may not consider, and things that you don't want to overlook, is what documents am I getting from the seller? A lot of times the seller may give you the leases they have in their possession. They may give you a phase one. They may give you a survey. And you want to make sure in your purchase agreement that your seller's obligated to give you these documents. Sellers not necessarily have to give you anything unless it's in the contract. So you want to make sure that you understand what due diligence documents you'll be getting from the seller and how they'll be delivered. I've had transactions in the past where there wasn't a mechanism for how these documents were to be delivered, and the buyer was forced to go to the seller's office and review the documents in their office. Given the situation we're in now, certainly not something that your buyer is going to want to do. We want to get those electronically through a Dropbox, so that the buyer is able to review those at their convenience with their advisors. So making sure that your contract says how the documents are going to be delivered. And also, how do we deal with additional documents? If we've gone through the list and there's something else that we want to review, do we have the ability to request that of the seller? And when the documents are delivered, a lot of our foreign purchase agreements says documents will be delivered within a certain amount of time. But if we have it's called a 21-day due diligence period, and the seller doesn't give us a document until day 20, do we still only have that 1 day to review, or can we extend the due diligence period based on that document? All issues that you want to think about and look in your purchase agreement to see what the terms are outlining, so that you're comfortable with your due diligence period and you don't run up against the deadline. You might be thinking, I can always ask for more time. Yes, you can, but it's up to the seller whether they're willing to grant that time. And what issue that we counsel our clients on is, if you're really getting in, down deep and doing due diligence, and you spent money on a survey, you made some money on an attorney or your accountant, and the seller doesn't give you more time, you're between that rock and a hard place where you either haven't completed your due diligence, or you terminate the transaction, but you're out of pocket on these due diligence costs. That's why it's important from the outset to understand how long you have, and really a right to extend this due diligence period. One other item that's often overlooked with due diligence is access to the property. Sellers going to want to protect themselves and say, if you cause damage to the property, you'll repair it, you will indemnify them, you'll have insurance. But from the buyer's perspective, what we want to think about is, what if the seller causes damage? What if we expose a pre-existing condition because we're doing a phase one on the property and we find that it's dirty? The buyer shouldn't be indemnifying the seller for pre-existing conditions or items that the seller caused. And those are important exceptions that you won't always see in your purchase agreement. So to make sure when you're reading these provisions that you are not, quote unquote, over indemnifying the seller for something that really should be their obligation. And rightfully so, even from the seller, they shouldn't be expecting the buyer to indemnify something that the seller actually caused. Given what we've been talking about and the environment we're in, I couldn't go through a presentation and not talk about COVID-19, and really about timing and the effects it's having on purchases and sale agreements and real estate in general. We're starting to open up, but third-party vendors may still be delayed. They may not be able to access a property. And you may not be, if it's a multifamily building, tenants may not want strangers walking through their homes at this time. So really with COVID, I think the biggest issue is think about timing. If you're not able to get into a property, your vendor is not able to access the property. Government office, you may be thinking about redeveloping it and you want to talk about permits and what you're able to do. A lot of cities are still closed or they're working on skeleton crews. I was dealing with one of our local counties last week and they couldn't take my call. I had to email and wait for a response. So really thinking about these issues, travel restrictions in terms of timing and how that's going to affect your deal. And maybe you still have that 21-day due diligence period, but you negotiate a right with the seller at the outset to extend it if you're not able to access a couple of the apartment units, or you're unable to get your vendor out there to conduct a survey or a property inspection. That way you're protecting yourself if you have to terminate, or you can extend the deal. Another kind of due diligence item is title and survey. And title insurance can't be understated because that's what protects you and makes sure you understand what you're getting. Title insurance ensures that you are getting the land that's been negotiated in the purchase sale agreement. And there are two types of title insurance, and kind of important to note the distinction. There's, which you may have heard as CLTA coverage by the California Land Title Association, is kind of your basic coverage. It ensures that the owner of the property is the owner of the property and they're the holder of title. There are no unrecorded claims and they're able to convey the land. The ALTA policy by the American Land Title Association is, let's call it your supplemental title insurance. And this adds additional protections and may even be required by your lender. So it's a good thing to talk about and see what's going to be required, because the ALTA policy can help protect you against encroachments. Maybe your neighbor's building goes 3 feet onto your property line, or there's an easement that runs under your property. Various title issues that you may not be aware of, and you may not understand them when you're looking at your preliminary report, but the ALTA coverage would protect you. Other couple items to look at with title is title companies offer endorsements, and they can help protect you against exceptions to the policy. If there are CC&Rs, or you want mechanics lien coverage because there was construction, you want to make sure that there's access because it's a flag lot. Important to talk to the title company earlier on before you waive contingencies to make sure that they're able to offer you endorsements if you need it, to make sure that you're comfortable with the title you're getting. And really the most basic of all is take a look at your preliminary title report. This is the report that in every real estate transaction with title insurance that you'll get from the title company. And too often, especially with smaller deals, maybe it's a 2-unit apartment building and buyer doesn't think there's much issue with title, I'm getting title insurance, but the title policy has exceptions to it. And they may be accepting to a prior deed, there may be CC&Rs, there may be certain easements, but really important to take a look at that. And if it's not something that's in your wheelhouse, have your advisor, whether it's your broker or attorney, other real estate consultant, look at that to make sure you understand that you're getting clean title to the property. Because if you're not, that's going to affect your ability to operate and the eventual resale value of the property. We talked about it, but I thought it was worth its own slide. Just to touch on briefly again is, how about a financing contingency? As Will mentioned earlier, capital markets are coming back, but it's still harder. Rates are great, but refis are difficult to get. A lot of banks have allocated so much money to the PPP program that they're struggling to get back on the footing to deal with smaller residential deals. So making sure that you talk to your lender earlier on, because your typical transaction, especially the larger ones, may not have a financing contingency, especially if it's a custom Word document from the seller's attorney. And you may have done your due diligence and then work on financing, but if you don't get your financing, you've already waived your contingencies and made your deposit non-refundable. So if financing is something you need to close the deal, really make sure that you have that contingency, you're able to get your financing on time, or you have the right to extend to be able to get that commitment from your lender. Talking about multifamily, you can't not talk about tenants. Probably the most important thing. When you're buying a multifamily building, you're really buying the revenue stream from the tenants. And it's important to understand, not only the tenants and their rights, but really what's in the leases. What type of rights do the tenants have? What's the default provision? What type of notice do the tenants have to give you? Is this a month-to-month lease, or is it a 5-year lease? And besides the lease, something that's overlooked and another kind of thing to be aware of is, has the seller made any side deals with their tenant? Sometimes the seller will make a promise to the tenant, oh yeah, you can stay here another 6 months, no problem, or I'll fix that leaky faucet, or you can keep the washer and dryer. And those agreements may be oral, they may be an email, and the seller just forgets to disclose them. What happens then is, without a commitment from the tenant, is you close and tenant comes to you as the new landlord and says, well, the old landlord promised me I could stay here for 5 years and pay $100 a month. Well, now you have a claim against the seller, but if the seller's an LLC, there may be no money there left, and you're stuck with the property, and you're stuck now fighting with your tenant, incurring legal fees. So an estoppel certificate is the document that we give to tenants, saying, you need to confirm what's in your lease. What is the rent that's being paid? What's the term of your lease? Are there any defaults under your lease for the landlord or the tenant? Are you committing bankrupt? Are you close to bankruptcy? Are there any side agreements? And what the agreement does is it, and hence the name, it stops the tenant from making these arguments against the landlord. So if the tenant in the estoppel certificate says my term of my lease is 1 year, and you close, and then they remember, oh, the old landlord promised me I had a 5-year lease. You as the owner can now point to this estoppel certificate and say, you told me it was a year, and the tenant is unable to make a different argument because the estoppel certificate is binding, and it binds them to that representation that they've made. Last important tenant document is what's called a subordination, non-disturbance, and entorpment agreement, SNDA for short. And this is what your lender is going to require. If you don't pay your mortgage, your lender wants to foreclose and take the building. The issue is, if you buy a property and there's a tenant in place, that tenant may have a higher priority on title than your lender. And if your lender forecloses, they wouldn't be able to wipe out the tenant's lease and would take title subject to that. So often your lender is going to want to execute this SNDA between lender, landlord, and tenant, which says the tenant's lease is going to be subordinated to the lender, so the lender can foreclose, but the tenant's lease is not going to be disturbed by the lender. They will honor the lease. It'll just be subordinate in priority. An important document when you're getting financing. And why I mention these here, given with what we've talked about timing, is oftentimes your lease may not require an estoppel certificate or SNDA, and that could affect your financing. And if you're dealing with maybe dealing with a commercial property or mixed use, and there's commercial tenants on the ground floor, larger tenants, they may have a 15, 20, even 30-day window to get you these documents. So you really want to take that into account when dealing with your lender in the closing, because you absolutely want to get estoppel certificates from your tenant. Otherwise, you're exposing yourself to risk for items that you may not know about in the future. Another important clause, I'm buying the property as is. What exactly does that mean? Well, it means the seller's not making any representations other than what's in the purchase agreement. They're not saying I'm going to guarantee you a certain return on your money. They're not guaranteeing that it's a Class A building or that's in a certain physical condition. You're buying it as you see it. And these provisions can be a sentence to 3 pages, disclaiming anything and everything regarding the property. You may also see a 1542 release, which as a seller you want. What that provision of our civil code does is say, I'm going to even waive claims that I don't know I have. So if I were going to learn something in the future, I can't go back and sue the seller. I've waived those claims. None of this is necessarily, a deal breaker or good or bad. It's just understanding that when I'm buying this property, I'm waiving my rights to make a claim. So if there's a gas station down the street, I want to make sure that I've done my phase one in my due diligence, because I'm not going to be able to pursue the seller if I find out the groundwater is dirty and I'm having to pay state and federal agencies for cleanup because I've waived those rights. So it ties back to due diligence, making sure that I've done everything that I think I need to do when I'm acquiring the property. Even if it's a small multifamily property, it may be next to a dry cleaner or across the street. And if it's in that proximity, you do want to make sure there's not environmental concerns, because that can get incredibly expensive, and it can affect your cash flow and your returns to any potential investors. Probably one of the most important things in your purchase agreement, representations and warranties. And this is how, as a buyer, this is how you get that inside information from the seller. The buyer really wants, I want comprehensive representations. It's a valuable source of information, and it's really how I protect myself post-closing, that if I found out that there were issues with the encumbrances or zoning or environmental conditions and there was underground storage tank, that I have the right to a claim to really go back and pursue the seller. In contrast, the seller wants to limit their reps. They want to wipe their hands of this property when they sell, and they don't want any lingering liability. So they're going to try to limit these reps as narrow as possible, maybe even limit them to their knowledge. I'm the seller, I'm an LLC with 6 members. Well, I don't want my passive investors any knowledge attributed to them. So I'm going to pick one person. Jeff Love is going to be, it's to my knowledge. And if I don't know that the property has an underground storage tank, then I didn't breach my representation. So really be on the lookout if there are representations and they're limited to knowledge, because that's a mechanism where a seller can shift risk to a seller and really limit the seller's liability to that one individual or entity in that knowledge. Another item on this to be on the lookout and be aware of is, how long does the representations and warranties last? There are deals when they may merge with the deed at closing. There are form agreements like I think the AR form has a 3-year survival period. So it's an often negotiated item between buyers and sellers. Buyers want it to be long and get in the property, get familiar with it, so they'll understand if there are any breaches, while the seller wants it to terminate as soon as possible. So all issues to look at, understand, and make sure that you're familiar with how long you have to make claims and what exactly is being represented and warranted by the seller. Limitation of liability is another hot topic, especially with us attorneys and dealing with liability. Is seller doesn't want to be liable. I sell a property, I want to be done. I want to take my money and put it into another building, buy equities, invest in a business. I don't want lingering liability. But the buyer wants to protect itself and be able to pursue the seller. So in your bigger deals, even smaller deals, I've seen them, the seller may limit their liability to 2, 3, 4% of the transaction value and say, even if I breach my representation, you're only going to be able to sue me for $250,000. I don't have any liability above that. What you also may see is buckets and baskets. And what I mean by that is, to avoid claims for $500, a seller may say, there's going to be a $10,000 threshold. And until you hit that $10,000, I don't have any liability. Once you hit $10,000, I'm liable for everything, or I'm liable for that $10,000 on up. So really pay attention if there is a limitation of liability provision from the seller's perspective. What is it limiting, and what's their out-of-pocket exposure? If there's environmental contamination, you could well exceed that limitation of liability. So really make sure that you understand that and you're comfortable with the risks moving forward, despite the limitation of liability. Default, we talked about my joke with Will earlier about that steak dinner. What happens if one of the parties default? We've gone through our due diligence. What is a default? Is the seller permitted to cure? Can they terminate the contract? Your typical remedy is you have your earnest money deposit. Seller's remedy is to take that and terminate the transaction. But what about attorney's fees? If they have to fight with escrow to get this money back, which we've done many, many times, and they spend $10,000, $15,000 on an attorney, is that money out of pocket and now eats into my deposit? Or can I get those on top of what the earnest money deposit is? What about interest? What about insurance? And similar for the buyer's remedy is I can terminate the transaction or I can get specific performance. What about attorney's fees? And one thing that's often overlooked is what about my out-of-pocket costs? Let's say I was buying a 10-unit apartment building. I got a phase one, I got a survey because I was thinking about redeveloping it, got a property inspection, I had an attorney, and I spent $25,000 on due diligence. And the seller just refuses to close. Now I can sue, or better, maybe they enter into a binding lease that I don't like. My choices are to go forward with this lease I don't like or to terminate. But if I terminate, I've just lost $25,000. So in that default provision, making sure that if I terminate, I'm able to get my out-of-pocket costs as well. And there may be a cap negotiated between the parties, but then it at least makes the termination option viable. Painful to do, but at least I'm not out-of-pocket money because of something bad that the seller did. And the last issue I think is important to talk about. It's probably, I say 9 times out of 10, it's overlooked. As a lawyer, we call them boilerplate provisions, and it's those miscellaneous sections at the end of a lease or purchase agreement where you may be talking about notice or choice of law, force majeure, counterparts, and provisions may say they're boilerplate, but they never really are, because any little distinction could have a dramatic effect on the transaction. It may be even your notice provision. If your transaction says that you have to give notice via certified mail and you send the other party an email terminating the transaction, they can argue that it's not valid and your notice didn't have effect, and that could be for your waiver of your contingencies. So your money could go hard just because you messed up on how the notice provision was supposed to go. So negotiating that and reading that to see if email is sufficient, if it has to be by overnight courier or FedEx. Is there attorney's fees provision? You may not always want one. If you think the other side is more likely to sue you than you sue them, and they're the ones that are going to get an attorney, you may not want to have that provision and then incentivize them to pay for their attorney's costs. Force majeure can't be more practical than right now. In every commercial lease deal, we've been looking to see if there are pandemic exclusions. Can tenants get out of paying rent because of it? Can I cancel a contract? So, looking to see what that provision does. Does it allow me to get out of my contract based on certain events? And lastly, I'll talk about merger. And you also hear entire agreement clause. And what that is, it says the 4 corners of my purchase agreement, that's what the parties agree to, nothing else. So if I have a term sheet, if I have emails back and forth that I said, the seller said I could extend the deal by just giving him notice, but it doesn't make it into the purchase agreement and we have a merger clause, court is not going to look at that email or that term sheet. Your purchase agreement is what's binding, and that's it. So an important clause to consider, because it eliminates all the prior correspondence and documents, and that purchase agreement is your sole binding document. So that is an important provision to consider whether you want it. And usually we do, because we try to put everything in the purchase agreement we need. But there are certain circumstances where you may not want it. And that is an important item to look for to see whether there is a merger agreement in your purchase and sale agreement. So that is my slides. If we have time, we can of course open it up for questions.
Yeah, thank you, Jeff. I definitely have a few questions based on your presentation and some of the things that we're seeing in our deals and stuff. So I'd love to throw some scenarios at you and see what you think. There's a transaction. I'm actually not the broker, but I am the property manager. And I was thinking about this while you were talking. So it's the one I spoke about earlier. There's a duplex in Highland Park that we manage. The owner has decided to sell because the tenants are not paying rent. Now, I'm wondering, I don't know if this agent she hired even knows that the tenants are not paying rent. And if she doesn't disclose that, what's her liability? And, how does that work? Because we haven't, as a property managers, we haven't been asked about anything regarding it, but they told us they're under contract. So I'm just curious, like, if tenants are not paying rent, and they're, in this case, some of their tenants are 3 months behind in paying rent. So how does, and that's not disclosed. How does that affect the transaction and the liability of the seller?
It's not as much the broker, unless there's a specific document that requests, like a single family transaction where you might be doing an inspection, or there may be a question where it's required to be disclosed. But otherwise, the broker's not under an obligation, or the seller's not under an obligation to disclose it unless there's a property information sheet or other document that asks about it. You as the buyer, that's an important question that you'll want to consider and make that request and get the current part of the due diligence documents, get a current rent roll and get that estoppel certificate from the tenant, because that will show when has rent been paid, when has rent been paid through. And if that lists March 30th, then you know that there's an issue. You can clearly ask the seller, and if you ask them and they denied it or gave you incorrect information, there's a claim. But without that request, the seller is not going to be under an obligation to disclose that information.
Very good. We do have a question here from one of our audience members. What is best practice when buying multifamily and the previous owner's leases were junk, have liability issues? Can you ask them to sign a new lease? You can ask them to sign a new lease, but you can't force this, is my understanding. That's the question.
Yes, good question. So one of the issues we typically do there is, you're right, you cannot force the tenant to sign a new lease, especially with our various rent, depending on rent control and where you are in the city. But one of the items you can do in due diligence is say, you put this onus on the seller and say, this lease doesn't work for me. I want the tenant to sign a new lease if you want me to go forward with the transaction, and see what the seller is able to do. Or approach the tenant at the time and see if they're amenable to signing that new lease. Maybe there's a concession that you or the current seller can give. Maybe the seller offers them a free month of rent on the seller's dime to do that new lease to get you to go forward with the transaction. The risk, and it's a good question, because if you didn't like the lease and you just closed, you are subject to those current leases for the term. You eventually could get a new lease. You can't evict the tenant for no cause, but you can get a new lease. But if that's a 2-year lease and it's just junk and you're on month 2, you would be bound as the new owner to the terms of that lease.
Yeah, and correct me if I'm wrong, Jeff, but our understanding is under LA rent control specifically, is that if a lease, a year lease, which is standard, right, automatically goes to month. And if there's any provisions in there that you don't like there's nothing you can really do if you accept the deal, right? Exactly, unless you deal with it before you close escrow. But if you don't, you're accepting that lease as is, and you cannot change the provisions of that lease, except for anything that LA rent control would allow, like, your 3 or 4% increases per year. That's the only thing that I'm aware of. Is that correct?
That's right. Because, and the reason is, if you enter this new lease and now you put these certain restrictions on this tenant, maybe they were allowed to have roommates, and then now all of a sudden you say 1 occupant when there were 3, you're essentially kind of almost forcing an eviction, because they're not able to force the rent. So that's what rent control protects. You're unable to add these, maybe not onerous to you as the landlord, but maybe onerous to the tenant. You're not able to edit that. You can change the rent, and just as you said, Will, you can change the things that rent control will allow, but you would be bound by the other terms of the lease. So it's a really important due diligence item to make sure that you understand the leases and that you're comfortable with them.
Yeah, we once had a deal. It's a triplex in Highland Park, same area. And I was looking at these leases, and the owner had basically said they won't have rent raises for 5 years. And it was in the lease. And we were like, wow, that's very generous of this landlord to write it in. But then he was like handing it off to us.
Exactly, and then you're stuck with that. And even to expand on that, why I was talking about estoppel certificates is, you may have that no rent increases for 5 years, but maybe it's in a side letter, or maybe it's in an email, and the seller doesn't, maybe purposely, maybe not, they just forget about it, and they're an out-of-state owner and don't really increase rent anyway. but they don't disclose that with the lease, you may never know about it. So that's why you get this ease estoppel certificates, so that your tenant has to tell you that there's no increases for 5 years. Because with that, you may not want to buy the building, or you want to negotiate that, because if you can't get it to market rent, or even even do the rent control statutory allowed increases, that could affect your underwriting and your cash flow on the acquisition.
So Jeff, regarding estoppels, like we've come across tenants who are not very cooperative. Maybe they had a bad relationship with their previous landlord or whatever it was, but they're not always willing to sign anything. So we don't always know exactly what those deals are. They're not always very forthcoming. I mean, have you come across that? Do you recommend anything we can try to do to get them to sign it, to make them know that, hey, it's also protecting them? Anything you can say about that would be helpful, because it's something that does come up. They're not always as easy to get as we would hope they would be.
Sure. And that is absolutely true. So a tenant it's a legal document, it may scare them, they're unfamiliar with it. First thing is look at their lease. Does the lease require them to sign it? If it does, and they don't, then they could be in breach of the lease. So that'll be some leverage to get them to sign it. If it's not, then it's a polite ask. Say, we, sign this, it protects, to your point, both of us. Still, then the tenant may not want to sign it. So in that circumstance, we ask the seller to sign it, and the seller is obligating itself to say, these are the terms, additional representations. If it's a 5-year lease, I'm telling you, it's a 5-year lease. It's clearly not as good as the tenant signed estoppel, because you close. If it's not accurate, you're stuck with the tenant. But at least now you have an additional claim against the seller, and you could pursue them for any breach and any damages you suffer. In that circumstance, I would look at too is, who's the seller? Is this an LLC where they're going to go take their assets and run? Or are they going to do a 1031 exchange where I have comfort that there's going to be assets to pursue in the future? Is this an individual? Because, well, I said it's not as good as a tenant. You have a claim against the landlord, but you want to make sure that there is a landlord seller that you can pursue.
Well, have you come across that where tenants won't sign and the seller will sign it? And
Absolutely.
what's your experience with that? Yeah.
It's definitely a problem, especially if there's a bad relationship between the tenant and the landlord. And it's always concerning for the buyer, right? If you can't get a tenant to sign. But I sell large units. I recently sold a 16-unit building. Getting all 16 of those units to sign estoppels was not easy. I'm selling a 30-unit now. Luckily, 25 of them are vacant. And interestingly enough, I'm representing the seller, but the buyer did not ask for estoppels. So I was actually excited about that, because I was like, oh, I don't even have to go get these 5 remaining estoppels, because it can be difficult, especially in our case. Like oftentimes there's a language barrier, trying to get them to understand. And a lot of times, like, there are people who are paying below market rents. They don't want to sign a piece of paper that they don't understand, and they're worried will obligate them to something, and so it's definitely an issue.
It's often negotiated too with, if you're buying a 200-unit apartment building, the seller may say, I'm not going to get one from every 200 tenants. I know some won't sign it, so I'm going to get you 90% of them from the tenants, and I will sign the other 10. We did a big retail transaction last year, and the seller did that exact thing, and they weren't able to get one from every tenant. Some just didn't sign it. Some had a dispute with the landlord, so the seller signed the remainder of them, and we made sure the seller had sufficient assets to protect the buyer. But to Will's point, the bigger it gets, the harder, to get everyone. So that's something for the sellers and the buyers. Maybe we negotiate some threshold where they have to hit that amount, but the remaining can be seller signed estoppels, and they'll just sign it for each of those units.
So I have a question. Something we run into a bit is, we standard usually use the California Association of Realtors CAR forms when it comes to purchase agreements and whatnot, but we do run across people who write a lot of like letters of intent, LOIs. And I actually recently got one on this 30 unit. And I was wondering, like, what kind of legal force do these LOIs have? Because they aren't standard. It is whatever terms the buyer is offering. And sometimes, as a seller, you feel like a car form will protect you more because there's more standard disclosures and whatnot. But with an LOI, you could never know. So I'm just curious, what's been your experience with that, and what legal force that they have?
With LOIs, they're going to get a lot more typical as the deal gets bigger. With your smaller deals, 2, 4, 6 units, you may just submit the entire offer on a CAR form or an AR form, and that's your contract. With your term sheet, they're typically not binding unless there's language to the contrary, and sometimes you will get a term sheet that's binding, but it's rarely the case. And the point of the term sheet or letter of intent is to make sure there's a meeting of the minds on the business terms. If someone's offering $1 million on a $10 million offered property, it may not make sense negotiating a purchase agreement or submitting an offer. So they'll submit an LOI to make sure you're close on terms. And then you may prepare a CAR form, or they may have their attorney draft, a purchase agreement. The LOI, the key is, when you're going through it, is making sure that it's not binding and making sure you're not obligated to certain things. Maybe confidentiality is binding, but price, terms, requirement to go forth with that buyer, making sure they're not binding. But it is a useful device to save time and money coming to business terms between two parties, especially when you get into larger deals. Because on those deals, those purchase agreements usually going to be negotiated a lot heavier. You may have attorneys on both sides. So before incurring those costs, if we can't even agree on price or timing or terms, why waste money on attorneys rather than consultants negotiating a purchase agreement?
Right. Are there any other questions from the audience for Jeff regarding purchase agreements or any other real estate related questions? I'm not seeing anything. Anthony, do you have anything that you want to?
No, I just want to say this is probably one of my favorite webinars that we've had. Jeff, you've been really, really amazing. This was great info. Thank you for all the slides that you shared as well. And just to remind everyone watching that we are going to be on Facebook and our YouTube channel as well. So this will be something that I'm going to go back and a few parts I want to hear again. Even though I've been doing this almost 20 years, it's like you're always, paying attention to different things at different times. So thank you so much, Jeff, and Will, of course, for putting this together. But otherwise, I'm good. I don't have anything else to say today.
I am getting some questions here asking for contact information for Jeff. So we'll post that on our meetup page. It was at the slide at the top. Jeff, there's some people asking for the slides, a copy of the slides.
Sure.
So we can provide, there it is. There's Jeff's email. So you can email him directly and ask him for a copy. As I said, if any of you guys have, there is one final question. Code or permit or lack of by owner selling property. With older properties, I see this as an issue. Can you think of an example of a code or permit issue that you ran into in a transaction, Jeff, that became an issue in the process of the sale?
We run across it fairly often, and that's one of the issues in due diligence is making sure, have you checked the zoning, have you checked, pulled the permits, and if there's an issue, one, approaching the seller and seeing if you're able to resolve it. If you're not, is that a risk you're willing to assume and close? And if it's an issue that you don't come across in due diligence, is that a representation that you can include in the purchase agreement? And that's often what we will do is the seller represents that they're in compliance with all laws, have obtained all permits, are in compliance with zoning. So if we're unable to discover anything during due diligence, and we find this out 6 months later, we preserve a claim against the seller to reimburse us for any damages that we suffered. So ways to deal with it both pre and post closing. Obviously, if you can deal with it before by doing your due diligence and discover it, the better. You negotiate a reduction in price or try to get the seller to fix it. If it can't be fixed and it's too big of an issue, you get back out of the deal. But if for some reason you couldn't find out, the representations is the section you want to make sure you have an appropriate language to protect yourself post-closing for something that you weren't able to discover.
I would say that the biggest issue that I see on the smaller multifamily deals is what's called the 9A inspection for the city of Los Angeles. And that is it's a document, a permit that shows whether or not the property has a legal permit to be hooked up from their sewer to the city sewer line. And I've seen, particularly with older properties in areas like Boyle Heights and whatnot, that sometimes these properties do not have a proper sewer permit. And that's something definitely to look at for the buyer before finalizing a sale. It's something I've seen over and over again. We're going to take one final question. Question about real estate. What is the normal length of the listing agreement for commercial property? And is the ARR listing agreement the best document for the listing agent? I have an idea on this, but I'm just curious what you think, Jeff.
Depending who we're representing, if we're representing the seller, we'll negotiate shorter periods. I'd say anywhere from 3 to 6 months is what we strive for. 6 months being common. If there's if the broker wants longer, we'll often do extension rights. But as the buyer, as a seller, you don't want to lock yourself into too long a period if it's not performing. Another issue, you also want to negotiate any tails with the broker, making sure that, to be fair, that they're compensated if they negotiated, and brought you a buyer, but that it's buyers that they really brought. I've seen many different types of listing agreements. AIR has a pretty good form. What you would want to look for though is pay attention to the timing and the terms, because every deal is different, and there may be a reason why you may have already had a broker, you may have a bunch of interested buyers that you've negotiated with, so you want to work that into any agreement that you're actually negotiating.
Yeah, in our case, we've always used CAR forms, California Association of Realtor forms, when it comes to listing agreements. But I know a lot of commercial brokers who like to use the AIR form. So I think it just depends on the type of property you're selling. I think for multifamily, a lot of people consider it a residential sale. So the CAR forms are often pretty good for that. And the normal length exactly could, obviously is whatever you can negotiate, but typically we do see 3 to 6 months. It can be longer sometimes, and it can be shorter depending on the situation with the seller. So I think with that, like Anthony said, I want to thank Jeff so much for your time and for your expertise. And if any of you want the slides, please email Jeff at his email below. If any of you have any questions for either Anthony or myself, please email us at the slides below. We are getting close to 1,000 people in this group, which is pretty amazing considering we started with nothing. And I think it's a testament to the types of speakers that we're able to bring, and like people like Jeff. Our next one is scheduled for I believe it's July 8th. Yes, it's July 8th. Again at 4:30. We're going to have Joel Dobrin from Cost Segregation Inc. speaking about cost segregation, which is a tool that commercial property owners can use to accelerate and help basically increase depreciation and potentially get more profits. So it's something we're going to be discussing at length in our next one. If you have any interest in any particular topic, please reach out to us and let us know, and we'll try to find a speaker that that deals with that topic. That's all I have. Anthony, anything else?
That's it. That's it.
Thank you, Jeff, again.
My pleasure, guys.